Today we are looking at two stocks that institutions, Wall Street are buying. They are two new stocks we haven't reviewed on the channel. One of them I do like, the other one not so much. We're also going to jump into both of these and run them through in our valuation model, getting to our intrinsic value as well as our acceptable buy price given our investor margin of safety. And we're going to take a look at their financial metrics as well as their dividend safety. So the first one that we can see here is Honeywell. Now this is a company that last year was down around 2%. It didn't have the greatest 2023, but we can see right now it is trading towards the mid to upper end of the 52-week range. It does offer a yield of around 2.06%. And if this is one you have been holding over the last 10 years, well, it would be a little bit of a rocky ride. You would be up around 119%. And we can see its all-time highs in the summer of 21 at around $234, not far off the current trading price. So let's take a look at the metrics. Well, dividend safety score straight away sitting at 99. It is very safe. Market cap 138 billion, a mega cap company. Now, in terms of the recessionary metrics, well, last recession, they increased the dividend, negative 18% recession sales, so this was below the average growth of companies in the S&P in 07-09, which sits around negative 12%, and they also underperformed the S&P with a negative 60% recession return versus the S&P's negative 55%. Now, in terms of dividend growth, well, above inflation that I always advocate on the channel, 4% or more, given that was the US inflation rate over the last 40 years on average. So you get that at 4.9% this year, or last year in fact, 8% on average over the last 5 years, 9% over the last 20. Not too bad if I had to give my opinion. In terms of dividend growth, well, they have been increasing it over the last 12 years or more. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So based on the yield right now at 2.06, we see a sign here of essentially reasonable valuation. Forward PE 21.3, pretty much bang in line with the 5-year average. And when we compare it to the industrials average of 19.7, Honeywell sits slightly higher. Now, when we take a look at the free cash flow payout, remember, we focus on free cash flow. Earnings is susceptible to manipulation by management through accounting. What we can see here is it has been pretty much below 60% over the last 10. And what we can see here is 60% is my preference because I do believe management are able to offer those double-digit increases to the dividend. We can see it has been increasing though from 2013. 2023 it is expected to increase higher to 72%, but 2024 it is expected to come down. Now, when we look at the free cash flow per share, fairly inconsistent, 431 in 2013, 666 in 2022. It has been increasing over the period, but not as consistent as maybe you would like. And we do see it top off at 840 in 2019 before coming down, expecting 575 in 2023. Sales growth 3 to 7% for steady moderate growth is what we like to factor in. Do note we do see 3 years of negative growth, although the last 2 years as well as 2023 is pretty much expected to be around that inflation rate of 4% that we discussed earlier. Numerically then, how does that look? Well, 39 billion of sales in 2013, 35.5 in 2022. It hasn't grown at all over the last 10 years, so something just to bear in mind. Shares outstanding, well, they do return excess cash to investor pockets by doing share buybacks. 797 million in 2013, 683 in 2022. Fairly consistent buybacks year on year. Now, ROIC, we're looking for 10% or more, giving us faith that management are able to effectively allocate their capital. Double digits every single year, very strong. 18% over the last 2 years, as well as expecting in 2023. In terms of the margins, well, positive to note on both fronts. Operating margin well above the 12% consistently, and in fact it has been increasing. Free cash flow margin, it did increase to around 17% before coming down pretty consistently, in fact, at 11% in 2023 expected. So something, in my opinion, just to keep an eye on moving forward so it doesn't continue to go further lower and lower. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. What we see here is the balance sheet strength as well as the dividend safety. These show us the number of years it would take the company to pay off all of their debt net of cash on hand. 1.09 in 2022, pretty decent considering our maximum is 3. 2023 expected to go up slightly higher to 1.38, still fairly comfortable. Now, in terms of institutions, well, there's around 74.61 institutional ownership. 7.81 billion worth of outflows over the last 12 months. Over the same period, a significant amount more of inflows, and we do see one of the largest inflows of Q2 of 2023. And as we discussed earlier, this is one that Wall Street have been buying over the last few weeks. So something just to note, but as always, we don't copy what the institutions or Wall Street are doing, and we should do our own due diligence. Now, jumping into the valuation model, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you continue notified of these videos as they drop. Now, typically, we run through each valuation model, getting to the intrinsic value, explaining whether or not it's over or undervalued based on the current market value. Today, we'll just jump straight to the output. So we have the multiples valuation, the dividend discount, the DCF. So jumping into the intrinsic value for Honeywell, what we have here is the intrinsic value, the average of the three models we've used. As each deep dive analysis, we do explain whether or not we do include certain models. This comes to $208. Now, in terms of the current price, we pretty much see it sitting at that value. So in my opinion, based on the estimates and judgments, this is one that currently trades at a 0% margin of safety with no real margin of safety, in fact. So what did Wall Street say? Well, they believe over the next 12 months, the share price to go up around 5%. So and this is very important. This should be a lesson for investors. Just because Wall Street are saying that this is one you should buy or whether the institutions are buying, it isn't one or a trade that you should copy. In my personal opinion, as we can see, it is pretty much trading at its intrinsic value with only around 5% upside per Wall Street. So for me, this isn't one that I would look to buy. Now, moving on to the next stock, we have another Linde PLC. We can see here 2013, in fact, it is up around 25%, pretty much in line with the S&P 500's performance. Again, trading in the mid to upper end of the 52-week range with a forward yield of 1.24%. Now, this is one that I do much prefer to the previous company, and we will explain why when we look at the intrinsic value calculator. Over the last 10 years, up 217%. Remember, it doesn't include those dividends reinvested, and we can see it has been moving at a fairly decent rate year on year. Now, in terms of what the institutions are doing, well, 81% institutional ownership, around 9 billion or 9.9 in fact, outflows over the last 12 months. The same period, a lot more inflows, and we can see, in fact, Q1 to Q3 of 2023, there have been more buying than selling by these institutions, and this also goes back to Q4 of 2022. So what about the metrics? Well, dividend safety score 99, very safe. Market cap just under 200 billion. It is a mega cap company. Recessionary metrics, well, they increased the dividend during the last recession, but they had below average growth during that period. Dividend growth, I like to see consistency, 9% February 2023, 8% over the last 5 years on average, double digits over the last 20 years, 13%. So that is very nice to see. And they are a dividend aristocrat, having increased those dividends over the last 25 years or more. Now, talk to us about dividend yield theory. Well, we can see based on that, it does look to be essentially overvalued. But as always, we don't look at any of these models in isolation. And based on the forward P ratio, we do see a sign of reasonable valuation with the forward P 27.3 versus that 5-year average of 26.7. Although note the materials sector P is significantly lower at 18.6. Now, free cash flow payout, remember, below 60% is what we look for, and we can see it has in fact been decreasing over the last 10 years. 2021, 2022 at a nice rate, 23 expected 48%. So this is positive, and we should expect those nice high single-digit increases to the dividend at a minimum. $3 free cash flow per share in 2013, $11.40 in 2022. Again, it is expected to decrease in 23 to $10.40, but still very nice increases. Yes, it's not consistent, but over the longer term, you do want the companies you invested to be in to be increasing over that period. Sales growth, again, fairly inconsistent. We see 3 years of negative growth. Also note 2023 is expected to be negative, but overall they do have some very strong years over the 10-year period. In terms of numericals, well, 12 billion in 2013, 33 in 2022, nearly 3 times growth over that period. One thing that I don't particularly like, they have done share issuances and diluted your position as a shareholder from 2013 to 2020, nearly doubling that share outstanding count. But from 2019, they have started to do share buybacks, and we see that currently in 2022 at 504 million. Now, ROIC, a little bit of a worry here. It did drop in 2018 to 3%, but it has picked up since then, so I do like to see that. 2023 expected 14%, so this does give me quite a lot of faith in management. They are able to turn around this company. Operating margin, free cash flow margin, again, not as consistent as one would like, but still, it's still moving in the right direction. 25% in 2023, well above that 12% minimum. Free cash flow, not really much to say. It is a very strong free cash flow machine. 22% in 2021, 17% in 2022, and 16% expected in 2023. Now, net debt to EBITDA, 1.2 in 2022, 1.17 expected in 2023. So again, well below that 3 that we look for. So that is a lot of positives about LIN. So again, let's jump into the valuation model. As always, if you enjoy the content, value is being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, click on that pinned comment below where you can run your own companies through to get to the intrinsic value as well as the acceptable buy price of these companies based on your own margin of safety and estimates and judgments. So intrinsic value at $482. We start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. It is a buy up to around $434. At 15%, a buy pretty much a few cents shy of the current trading price, so we believe around a 15% margin of safety. Well, what did Wall Street say? Well, we can see around $447 as their target over the next 12 months, so they do see around 10% upside. So in conclusion, we believe that Linde has around a 15% margin of safety based on our estimates and judgments, with Wall Street expecting around 10% upside over the next 12 months. Now, this should be a good lesson just to let you know, just because Wall Street are buying or whether they're tipping these stocks or the institutions continue to put money through, you shouldn't always be following whatever they do. Always do your own due diligence. Try to get to a reasonable intrinsic value based on your estimates and judgments, and therefore decide whether or not you want to take action and invest based on your own research and due diligence. As always, don't follow anyone. Always do your own research when you are looking at stocks. As always, if you enjoyed the content, smash the like button, hit the subscribe and bell button so you are notified of these videos as they drop. Happy New Year. Catch you all on the next episode and take care.